What if I told you that a 5,000 credit card purchase could end up costing you more than 10,000 if you repeatedly only make the minimum repayments and still leave you in debt for years? You did nothing wrong, no missed payments, no late fees, just doing exactly what your statement asks you to do. So what's going on? The issue isn't that you are doing something wrong. The minimum repayment is designed to do one thing. And today, I'm going to show you what it's actually doing and what that also means for your money over time. If you're new here, welcome. I'm Novah. I've spent over 15 years inside the banking industry as a credit risk professional. On this channel, I talk about debt topics from a risk perspective, and my intention is just to replace fear with facts on consumer debt issues so we can all win with our debts. And if these are topics that interest you, consider subscribing and like each and every video that makes a difference to you, and share your comments too. Everything I share in this channel is purely for general financial education and is not meant for personal financial advice. Later in this video, I'm going to explain something that catches people completely off guard. What happens to your interest-free days the moment you stop paying your balance in full? It changes the picture entirely. We'll get there. Let's start with something most card holders have never actually looked up: how the minimum repayment figure on your statement is calculated. Typically, it's around 2 to 2.5% of your balance, or a fixed minimum like $20, whichever is higher. It's different for different lenders. So on a 3,000 balance at 2.5% minimum repayment, that's around $75. On 5,000, it's around $125. That sounds manageable, and that's by design. The minimum repayment feature is there to keep your account in good standing and to reduce your risk of default if that is all you can afford to pay in that particular month. That's it. It's not designed to help you pay down your balance faster. Those are two different objectives, and understanding the difference is the whole point of this video. By and large, a credit card can be a very great tool for short-term spending, but a very expensive tool for long-term debt. For example, using a credit card for a major house renovation that will take you years to pay is like using a taxi for a cross-country road trip. It works, but it's probably the most expensive option and may not be the right use of a credit card. There are several other bank products that are designed for that. And with that, honestly, there's nothing wrong with how minimum payment is designed to work. It's a product feature meant to support customers, not a trap. But if you don't understand what it's actually doing, you can spend years paying a bill and barely moving the balance. Let's look at the real costs with an illustrative example. Let me make this clear with an example using the MoneySmart credit card calculator, which I'd encourage anyone watching to try themselves. Imagine someone, let's call her Maya, who was 5,000 on a credit card at the average interest rate of around 20.99%. She pays every month, never misses a repayment, always pays the minimum. Here's what happens to Maya. The minimum payment starts at $125, depending on the card. But as the balance slowly reduces, the minimum reduces too. The repayments shrink, which means it takes even longer to pay it off. A balance in that range at that rate on minimum payments only can take over 26 years to clear, and the interest paid over that time can end up close to or higher than the original balance itself. And these are model estimates. Actual outcomes will differ. For example, if there's additional spending on the card, there are annual fees that get charged, or changes to the interest rate. You'll also notice in the statements that in the early months, a large portion of each payment goes to the interest, not the principal balance. So even though you are paying every month, the debt moves very slowly. Maya didn't borrow twice. She just paid slowly. Now, compare that to Maya paying a fixed amount every month, say $250. Same balance, same rate, The same calculator shows the payoff time drops dramatically from around 26 years to approximately 2 years. And the total interest paid falls from around 10,000 to approximately 1,000. That's a saving of around 9,000. The difference isn't the amount she borrowed, it's the repayment behavior. And now, here's the thing I mentioned at the start, the one that catches people off guard. Most credit cards offer an interest-free period, often up to 45 or 55 days on new purchases, depending on the card, definitely. Many people know this. What fewer people know is what makes you eligible for it. To access the interest-free period, you generally need to have paid your previous month's closing balance in full by the due date. The moment you carry a balance, even if it's $1, that benefit typically disappears. New purchases start accruing interest from the day you make them, not from the due date. And it's worth checking the exact conditions with your lender. Not all transactions attract the interest-free period. Cash advances, for example, generally don't get that. So if Maya is paying the minimum, she's not just paying interest on her existing balance. Every new purchase she makes goes onto a card that's already accumulating interest with no grace period. The debt grows faster than most people realize because the interest-free buffer is gone, because she only paid minimum repayments and didn't clear the balance. And this is usually the point where people realize paying the minimum isn't neutral. It's a choice with a real cost. And the cost compounds quietly, month after month, especially when the cycle of pay minimum, use the card again, pay minimum again, and that continues and repeats itself. Short-term borrowing quietly becomes long-term debt, not because of one big mistake, because of small, repeated patterns. And here's something worth knowing from a credit report perspective. Making the minimum repayment on your credit card will not damage your credit report as long as you pay it by the due date. It fulfills your credit agreement. It's recorded as a successful on-time repayment, and it helps maintain a positive credit history. Many people have legitimate reasons for managing cash flow this way at different points in their lives. When a lender reviews a credit application, they can see your repayment history. Consistent minimum repayments aren't automatically a red flag. If you're planning to apply for a home loan or even a personal loan in the future, your credit card payments history is part of the overall picture a lender will consider. I want to be clear about something because this matters. Credit cards used well are genuinely useful financial tools. Remember, this video is not about telling you to get a credit card or not. That's your own personal financial decision. Personally, I have a credit card and have previously used the minimum payment feature in a few occasions, but for a very short period of time as my circumstances required me to. And that's a feature I would still maintain because I don't know when I will need it next. Credit cards, depending on the card, can offer purchase protection, fraud coverage, travel insurance in some cases, rewards points, and access to an interest-free period that effectively lets you use money for free for up to around 6 weeks if you pay in full each month. Someone who pays their balance and earns reward points is using a credit card to work in their favor. They access benefits, the card is working for them. The challenge with the cost is when the card flips, when the balance starts carrying over repeatedly for a long period. The interest-free period disappears. The minimum payment becomes the constant habit, and the debt starts to compound. The product hasn't changed. The behavior has. And understanding that line is what separates people who use credit cards well from people who find themselves in a cycle they didn't see coming. So what can you actually do with this information? So here's a practical part on what you can do if the long-term cost is currently a concern to you. First of all, you need to understand your numbers. You need to know your balance and your interest rate. That's the starting point. Second, You can use the MoneySmart credit card calculator. It's free and it will show you approximately how long your current balance will take to clear, how much interest amount you will pay. The link is in the description, and it's one of the most useful 5 minutes you can spend on your finances. And third is that if you're carrying a balance, you can consider paying a fixed amount rather than the percentage minimum if your circumstances allow and if you're in a position to. Even a small increase above the minimum makes a material difference to how quickly the balance falls and how much interest you pay. And we saw with the calculator, it clearly illustrates this. And fourth, if the balance feels unmanageable, speak to your lender early or reach out to a financial counselor or advisor. The National Debt Helpline is free and independent. They can help you work through options as well, including whether a structured repayment plan makes sense for your situation. And as I close, I just want to say that credit cards are not the problem here. The minimum repayment is also not a trick. It's a product feature that serves a specific purpose. And it's worth understanding exactly what that purpose is. When you know how the minimum is calculated, what it costs over time, and what it means for your interest-free period and your credit file, you are in a position to make a deliberate choice about how you use the card. If you only remember one thing from this video, just remember this. Minimum repayments serve a specific purpose and is a valid product feature. Repeated minimum payments can make you stay in debt for longer. Extra payments help you get out. And that's what winning with debt and replacing fear with facts actually looks like. Let me know in the comment section what surprised you most about minimum repayments for credit cards. If this video helped you understand the topic a little better, consider giving it a like and subscribe for more practical insights about debts. Till next time, keep winning with debt. Thank you.